But there's this constant conversation around this AI bubble out there from the media, and a lot of folks tying it to the early 2000s dot-com bubble. Afternoon, we have some delayed jobs data in this week finally, and all eyes were on NVIDIA as earnings, and this kind of conversation of this AI bubble headline continued to pick up steam. So we have a lot to cover here this week. I'm Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal is to leave you feeling more empowered every interaction and to hopefully bring to you some real data-driven updates here in our weekly updates every Thursday. And we have quite a bit to cover again this week, primarily around some of the data that has been released after the government shutdown finally came to an end. So we'll start there. So basically the data that came out this week was really around jobs is where we're going to focus. So there was finally some job data that was released after the delay. Before we get into those numbers, just real quick, we also had initial jobless claims come out today at about 220,000. So not too much to write home about there. But the big news is really the release of the delayed jobs data. So today we had the employment report and the unemployment rate come out from September. Okay, so keep in mind this is September's data. Employment report shows that we added 119,000 jobs in September. The unemployment rate shows that we're at about 4.4%. Now, the reason I'm highlighting this is that the market loved this, basically. So again, added 119,000 jobs in September. This was higher than expected, and we saw the market reaction pretty significantly. Now, this is off the back of NVIDIA's earnings yesterday after the close, so I'll talk a little bit about that as well. But this combination has sent the markets really in a pretty big jump here on Thursday morning. And again, not just the stock market, but we also saw the bond market. We saw yields decrease a little bit as a result as well. I think if it helps, the reason for this is that, the conversation with the Fed has been this polarizing data between potentially a struggling labor market and this constant pressure of some higher for longer inflation. And this was a sign on the labor market side of it that maybe things aren't quite as bad as the signs were starting to point towards. Now, time will tell. There's a lot more data to come before that December meeting coming up here before the end of the year for the Fed. But nonetheless, this was a great number to see on the labor market side of it. And again, a bit of a sigh of relief given all the jobs data we had seen leading up to this. And markets certainly, really enjoyed seeing this as well. We also had the Fed meeting minutes come out, which came out yesterday on Wednesday. And it's very interesting timing because basically many had suggested that they felt a December rate cut was not necessary. And so yesterday we actually saw bond yields pick up quite a bit off of this release. So a little bit of conflicting information there. We got the Fed meeting minutes yesterday saying basically, because of the labor market concerns, they may not cut in December. And then today, we obviously received a labor market report showing that things might not be quite as bad. So what this means for the Fed, time will tell. Again, a lot of data between now and that December meeting, but very interesting, especially to get them back to back like that, right? Before we get into our main question of the week, which is this media story of this AI bubble, be sure to tune in next Thursday because speaking of a lot of data, we should get a lot of inflation data, income and spending, all before the holidays. So get ready. We've got a data intense week coming up here next week, even on the shorter week with the shorter trading days, and then of course Thursday for the holiday. But before we break this week, there has been this big story of this conversation around an AI bubble, and the media has been covering it like crazy. It's picked up a lot of steam over the last week or so. Now, I have the fortunate ability to be able to share this after NVIDIA's earnings yesterday, but really all eyes were on that. And what I want to do, though, is besides just NVIDIA, I want to zoom out a little bit about this conversation because it's likely it could come back to the forefront again, too. NVIDIA's earnings were strong, so basically, and more so suggested a strong outlook. So it kind of shot this down, at least for the short run. But there's this constant conversation around this AI bubble out there from the media, and a lot of folks tying it to the early 2000s dot-com bubble. And so that's what I want to break apart because I think that this is a bit over, a bit of an over reaction to what's going on. We have been talking about here at Mainsail this idea of tech valuations being extremely high for a very long time. And we still feel that's the case. Even after NVIDIA's earnings yesterday, the reality is the valuations on some of these companies are set for a very, very rosy long run there. And it doesn't mean they can't deliver, but it does mean they've got very high expectations to be able to kind of keep moving to these valuations over the long run. So this idea of an AI bubble and equating it to a dot-com bubble from back in the early 2000s just seems a bit extreme. The reason I share that is if we go back to the early 2000s, you may remember things like pets.com, right? I mean, really any company that put a .com at the end of their name was going public and getting very high valuations on basically no value. And that is the difference, right? Back in the early 2000s, a lot of these companies were going public. A lot of investors were buying them without any real revenue or profits or assets in any way to speak of. And that was the issue, is that there was a lot of purchase of what could be when there was nothing there, period. In today's world with this AI bubble, what most of this is being driven from is actually some of the top companies in the world, right? These are multi-trillion dollar companies that were very successful before AI was even necessarily a thing, very diversified in terms of their revenue streams, and are now, sure, investing very heavily in AI, and obviously a lot of investors piling in hopes of what could be. Now, I do think, to be fair, that has led to significant overvaluations, or at least valuations that really require these companies to deliver just exceptional results for a long time to justify them. But it's not the same as a dot-com bubble, because we don't have shells of companies that are worth billions of dollars without any real revenue or assets to speak of. These are very, very strong companies, very, very well-run companies that are not just putting a .ai at the end of their name. They are truly ran well and have numbers of lines of business that create some diversification as well, right? So again, for them, for the tie to the .com bubble, I think is not fair. That said, there is something to be said about this AI bubble, which is that more so I would call it an overvaluation situation, where if things start to normalize, which could very well be the case as AI gets more competitive, you could see valuations get back into more of a normal line of valuation or price to equity equation there. So I hope that helps. This has been a big headline as of lately, and actually we've had a lot of questions, so wanted to make sure to kind of share it on this format as well. Be sure to tune in next week. Again, we will probably bring it to you on Wednesday instead of Thursday, given the holiday, but we'll have a lot to cover with some inflation data and and income and spending, all again right before the Thanksgiving holiday there. So have a great upcoming weekend. We will see you next week. And in the meantime, if you have any questions, let us know too. We're happy to share that in kind of this weekly update format. If there's anything on your mind we can address.